the same time, if our view is bullish, we will sell the PE. The intrinsic value, right? This intrinsic value will remains. Hi friends, welcome to my YouTube channel Trader Chitra. In this video, we will discuss in detail about one of the most versatile derivative instrument, that is options. We will see options in detail right from the basic, such as defining what is an option and the types of option, and gradually proceeding to more complex areas such as option Greeks and option strategies. Now we will see what is option. Option is a derivative, a contract that gives the buyer the right but not the obligation. Obligation means promise to buy or sell the underlying asset by a certain date, means expiry, at a specified price. Again, specified price means strike price. We will see types of options and what is meant by strike price, option price, expiration date, etc. in detail. We will see what is derivatives. Derivative is an instrument whose value is derived from one or more underlying assets. What is assets? The underlying assets may be commodity, foreign exchange rate, bond, loans, shares, stock or index. Derivatives are classified into two types, futures and options. Options classified into two, that is call options and put options. Call options we can buy or we can sell. Again, same for the put option. We can buy the put option and we can also sell the put options. We will see how an option works with an example. Assume that you want to buy a property with the total size of the property is 1000 square feet and cost per square feet is 4000 rupees. So I will write down here. So rate of the property, that is 4000 rupees per square feet. Okay. Now what is the size? Size is equal to 1000 square feet. Okay. Now next is the total cost. Total cost, how will get the total cost? Rate multiplied by size. Number. So the total cost of the property is 40 lakhs. Now we will go with the agreement with the seller that we will buy this property in X number of days. So for that X number of days, we will pay certain amount of interest to the seller. Now the price equal to 4000 rupees. So what is the interest you are going to pay to the seller is? Interest is equal to 50 rupees you are going to pay the interest to the seller. So totally how much interest you will pay to the seller now? That is 50 multiplied by 1000. That is equal to 50,000 you will be paying to the seller. This 4000 can be written as 3900 plus 100 rupees per square feet. Okay. So for 4000 rupees you paid 50 rupees interest to the seller. So for 3900 rupees you are going to pay 45 rupees interest to the seller. So what is the amount you are going to pay to the seller is equal to 45 multiply 1000. So the amount is 45,000 rupees you are going to pay to the seller. So we will pay 45,000 interest to the seller. Now 100, the 100 into 1000, okay, that is equal to how much? It's 1 lakh rupees. Now the total amount that you are going to pay to the seller will be how much? That is equal to 1 lakh plus this 45,000 rupees, equal to how much it is? 1,45,000 rupees. this 4000 can be, again we can split into 3800 plus how much? 200 rupees per square feet. Okay. So now the interest will reduce to 40 rupees. So the total amount of interest that you are going to pay to the seller will be now 40 into, that is 40 multiplied by 1000 equal to 40,000 rupees. That is the total interest you are going to pay to the seller. Now again this 200 multiplied by 1000 equal to how much? 2 lakhs. So the total amount is how much now? Equal to 2 lakh plus 40,000, that is equal to 2,40,000 is the total amount of money that you are going to pay to the seller. Now again we are going to split this 4,000 into 3,700 plus 300 rupees per square feet. Okay. So the interest amount that will be again reduced to 35 rupees. Okay. So here the interest amount multiplied by 1000, that is equal to 35,000. So this 300 multiplied by 1000 equal to 3 lakh. So that is equal to 3 lakh plus 35,000. That is the total amount of interest that will be paying to the seller now. Now if we agree to pay 4,100 rupees per square feet to the seller. Okay. So the interest is 40 rupees. So how much is the total amount of interest you are going to pay? That is 40 multiplied by 1000, which is equal to 40,000 rupees is the interest. If we pay 4,200 rupees per square feet, the interest is 35 rupees. So the total interest will be 35 multiplied by 1000 equal to 35,000 rupees. We are ready with the calculations now. We will see how can we relate this with the options. We have written this 4,000 rupees per square feet, right? This 4,000 is the current market price. Okay. Again, this 1000. What is this 1000 in option? This is the lot size. Now the price we have written here, right? 4,000, 3,900, 3,700, 4,100. These are all what? These are all the strike price. Okay. So I will write here 4,000, 3,900, 3,800, 3,700. Next is 4,100. 4,200. This 100, 200, 300, right? These are all the intrinsic value. Hundred, 200, 300. The interest which we pay to the seller is the premium. This is the total interest or the time value. This is the intrinsic value. This is the total amount that is we are paying to the seller. From calls perspective, the current market price is 4,000. So in option, this 4,000 is called ATM, that is at the money. And the strike price which is nearest to at the money is called ITM, that is in the money. So this 3,900, 800, 700, these are all called in the money, that is ITM. Now 4,100 and 200 which is above 4,000, that is called out of the money, that is OTM. This is the NSE website, and now we are looking into the option chain of Nifty 50. The current market price is 18,185. So the strike price near to 18,185 is 18,200. So 18,200 strike price is at the money. So this is the strike price which is marked in the center, and the values which marked on the left side, you can see here, this is for the call side and this is for the put side. The strike price which is marked in yellow, these are all called ITM, and which is marked in white, these are all called OTM. Same for the put side. I have copied the option chain details from the NSE website for comparing with our example. The current market price is 18,185. So in our example, I have shown it as 4,000. The strike price which is nearest to 18,185 is 18,200. So that is ATM. So 18,200 is ATM for both call side and put side. From calls perspective, the strike price which is marked in yellow, these are all called ITM, that is 18,150, 100. These are all ITM. And the strike price which is marked in white are called OTM, 18,250, 18,300. From puts perspective, strike price marked in yellow, that is 18,250, 300. These are all called ITM, and strike price marked in white, these are all called OTM. In the subsequent videos, we will discuss about the other columns in the option chains. As we made an agreement with the seller that we will buy the property in X number of days, but if we didn't buy that property during that particular period of time, the interest will become 0. Same will happen in the options, that is the options, the ATM and OTM options will become 0 during the expiry. For ATM, the interest we paid, right, the 50 rupees, that interest will become 0. Okay. And when it comes to OTM, OTM also the same, the interest we paid, that interest will become 0. Okay. When come to ITM, the interest will become 0, but the intrinsic value, right, this intrinsic value will remains. We will see in detail what we have learned till now. Instruments can be traded in cash, futures and options. The stock that we are buying in cash have no expiration date and we can held forever. That is, we can sell after 1 year or 2 years. Why? Because the stock which we are buying in cash have no expiration date. But at the same time, all options have an expiration date, which means they will no longer exist and we cannot trade after that, they expire. Options are organic and they will born, they will grow and they will die within the certain period of time. Then why we use option? Option is used for hedging and also will help us to understand the future direction of the market. Also, options will help the traders to implement different strategies to increase their income of the traders. Then we will see what is call option and put option. If the view is bullish, then the traders will buy the call option, that is CE. And at the same time, if the view is bearish, then what the traders will buy? The traders will buy the put option, that is called PE. How we will calculate the option price? Option price equal to intrinsic value plus time value. CE, PE. CE is call option European style settlement. E stands for European style settlement. We do also have CA and PA. CA means call option American style. That is, A stands for American style settlement. European style options exercised only on the expiry date, but American style options exercised anytime prior to the expiry. In India, both the stocks and index options are European. We are using only CE and PE. Options from the buyers and sellers perspective. If our view is bullish, we will buy the call option. We have the right to buy and no initial margin required, we will pay the premium. At the same time, if our view is bearish, we will sell the call. That is, we call it as writers. We have the obligation to sell. We will pay the initial margin and we will get the premium. We will receive that premium. Say for example, if we are writing the call, that is we are selling the call at 150 rupees, we will get that 150 rupees as the premium. That premium is the 150 rupees. And same for the put option. As a buyer, if our view is bearish, we'll buy the PE. We have the right to sell, no initial margin required, we'll pay the premium. At the same time, if our view is bullish, we will sell the PE. We have the obligation to buy and the initial margin we have to pay and we'll receive the premium. From the buyer's perspective, in order to buy the call and put option, they will pay only the premium and the reward is unlimited. From the seller's perspective, in order to sell the call and put option, they need high margin and the reward is fixed reward. Time value favors. Time value favors means decay. We have decay in options, right? So for that, sellers, they will get more advantage in the decay. Expiry date is the particular contract will expire on the given date. Every derivative contract have an expiry date such as stock, commodity or currency. We have weekly and monthly expiry. Index such as Nifty and Bank Nifty have weekly and monthly expiry, but all the stocks have monthly expiry. When the weekly contract will expire? That is every Thursday of the week, and monthly contract will expire on last Thursday of the month. These are the option Greeks, that is delta, vega, theta, gamma and rho. As an option trader, it is good to understand all these Greeks. In my upcoming videos, I will explain in detail about this option Greeks and also the option strategies. Hope this video is useful to you. Please don't forget to like, share and subscribe. Click the bell icon too for my upcoming video notifications. Thank you for watching.